Welcome to Close of Business. I'm Alicia Barry. The Australian economy has growing pains. The September quarter rise of 0.4% came in below expectations. Despite that, the economy is growing at its fastest annual pace in 2 years. And in better news, a closer look reveals it's the private sector doing some of the heavy lifting. Emily Stewart begins our coverage, including what it could mean for rates.
Business is heating up at this air conditioning company. It's just built this new $28 million facility.
Every year we make a little more. 2024 was a record year. 2025 is shaping up to be another record year for this factory.
With it comes more staff.
Initially we planned to hire about another 45 people, but it's exceeded our expectations and we've created 60 new permanent full-time roles.
It's reflective of the broader economy.
The really encouraging part of these numbers is to see that the growth in the private sector is gathering pace, and that's powered by the strongest growth in private investment in almost 5 years.
The Australian economy grew 0.4% in the September quarter and 2.1% over the year, driven by business investment, predominantly on data centres, and household spending on essentials like rent, power and insurance. Australians decided to put away a bit more of what they earned, pushing up the savings ratio. The big drag on growth came from mining and gas companies selling off stockpiles while they performed maintenance. Imports also grew faster than exports. Economic growth in the quarter was weaker than economists were expecting.
And we saw a contraction in spending in those areas that are not essential spending.
Households can't rely on any relief from the Reserve Bank when it meets next week. Most economists expect rates to remain on hold, with the possibility of rate hikes next year.
The RBA will stay on hold over the next few months. We think they'll stay on hold over next year, but they'll be alert to price pressures in the economy, given that underlying inflation is elevated.
Speaking before the GDP figures were released, RBA Governor Michelle Bullock defended the central bank's decisions.
We've got an unemployment rate of 4.3%, and we've got an inflation rate at 3.2 at the moment, admittedly, but forecast to come back down into the band. And so I think the strategy still is alive.
The fridge comes up, then you've got the cupboard.
This high-end builder has seen the cost of materials rise, but that hasn't stopped new contracts coming in as investment in the sector continues to grow.
We don't advertise for work, work comes to us.
But he could be expanding further if it wasn't for red tape.
I'd say the red tape's what's stopping us getting going, because if we had some of those projects going now, I could put on more people if I had the skilled labour.
Calls to build policies that will allow the economy to grow faster.
The growth figures have underlined expectations that the next move in interest rates will probably be up. Financial markets are pricing in a 60% chance of a hike by mid-next year and a 100% chance for a move higher by the end of 2026. David Bassanese is the chief economist at BetaShares. I spoke to him earlier. David Bassanese, a couple of months ago, people were celebrating the prospect of a rate cut. Now we're talking about rate hikes. How did we get here?
Yeah, it's interesting. I mean, I think two things essentially have driven this. Firstly, the inflation numbers for the September quarter were higher than expected. The underlying measure of inflation grows by 1%, which is a 4% annualised pace. And in fact, then the inflation numbers for the month of October are also on the high side. Coupled with the fact that economic growth or economic demand was pretty strong in the third quarter when we got the national accounts only a few days ago. So I think the markets are thinking maybe the economy, it's great, the economy is recovering, it's picking up, but maybe it's starting to lead to, inflation picking up as well. And as a result, there could be a risk that the RBA needs to, rein in the economy and raise interest rates. So it has been a bit of a sea change in thinking.
Absolutely. Well, let's go back to that growth data, the third quarter GDP. The headline wasn't as strong as expected, but as you say, there was a real indication that the private sector has been doing quite a bit of heavy lifting. Where can the economy go from here?
Well, it really comes down to, is that pickup in demand that we're seeing? As you mentioned, GDP itself was only up 0.4%, but we had a stock rundown that accounted for that. Domestic demand across consumers, business, even the public sector was pretty strong. It was actually up 1.2% in the quarter. Look, things can keep going. There's good momentum, I think, in the economy. The only problem is that if it does lead to, if we are sort of at capacity constraints, if the labour market is too tight and it's leading to a pickup in inflation, we may need to rein that in. So that's the challenge, the juggling act the RBA is going to have to deal with over the next 3 to 6 months.
And we see market bets for a rate hike by the end of next year at 100%. That sounds like a certainty, but could one bad jobs report, for example, just blow that case up?
Maybe not one, but a few. It comes down to obviously the economy, activity and the inflation, most importantly the inflation numbers. So if inflation, we now have a monthly CPI. Now if that shows inflation annualised running at above 3%, as it's been doing, then the RBA would be, I think, have no choice but to raise interest rates. My expectation is it will ease, but that is the real challenge at the moment. Now, if inflation stays high, but the unemployment rate, if the economy does suddenly weaken, then it'll be a more balanced outlook, and we actually might see interest rates stay on hold in that type of environment.
Well, it's the last meeting of the year for the RBA next Tuesday. They then don't meet again until February. No move is expected. But are you thinking that perhaps we might see a language change from the RBA governor? And if so, what would you be expecting that she might say?
Yeah, look, I think they'll maybe start to open the door to the possibility of a rate rise, not necessarily predicting one, but just making, that it's a more balanced outlook. I think up until recently, it's been either they leave rates where they are or they cut them, whereas now it's an open question, maybe the next move will be up. And again, one of the things we get from the meeting is what they have two decisions in the meeting, and the question next week will be, was one of those decisions potentially to raise interest rates or not. And so I think that'll be an interesting outcome.
Well, Westpac is going in a different direction to the consensus, flagging the possibility that we could see 2 rate cuts next year. The argument that most of the high inflation is in sectors that are outside of the control of interest rates. What's your thoughts on that?
Not sure that's a strong... end of the day, the RBA has to target inflation one way, irrespective of where it's coming from. So if inflation stays higher than we like for a long time, the problem is that it could feed into inflation expectations and then become a bit embedded. So the RBA does have to react to it. I think what my sense is that maybe some of the lift in inflation we've seen recently is businesses restoring some of their profit margins that were hit during the economic slowdown that we had. And that's maybe a one-off increase in prices that won't persist. And if that's the case, then the rate of inflation should start to drop down. That would be my expectation. But again, if it's percolating, then that would be not as good news, and the RBA, unfortunately, would be forced to respond.
Well, you were one of the few economists that correctly predicted that the RBA would be on hold in July after a very hot inflation rate rather than cut. What's your prediction for rates in 2026?
Yeah, so I'm actually backing the Westpac view at the moment, and I think we're in line with that. I still think the next move in rates will be down. But again, it's dependent on that rate of inflation dropping back below 3%. And if that happens, interest rates are still at restrictive levels, and the RBA can bring them back to a more neutral level. But so it's interesting next year. It's either going to, I think, one way or the other, because if inflation doesn't fall, then they may have to raise rates.
If we saw a cut, when, briefly?
May. I think you're going to need to see a run of months of data to be convinced about what the direction of inflation will be. So February's too early, May's probably more likely.
David Bassanese, thanks so much.
No worries, great to be with you.
2025 has been a seller's market with 10 straight months of price rises. But the threat of rate hikes and poor affordability could put the brakes on home values in the new year. The latest numbers show Perth, Brisbane and Adelaide leading the gains, with momentum in Sydney and Melbourne flagging. Eliza Getzi has the story.
This open home may not look busy, but the one-bedroom apartment is up for sale in the nation's hottest property market.
Double door pantry. It is definitely the most crazy market that I've ever seen. There is so much demand for people wanting to purchase properties, very, very limited stock. and so competition is high, which is obviously driving the price.
Here in Perth, the number of properties available to buy remains more than 40% below average. Agent Natalie Hatton has seen prices jump in the last month and a half.
There's so many people looking to buy. There's no rentals, so they're trying to take advantage, if they're a first home buyer, of the first home buyer scheme.
Nationally, prices rose 1% in November and 7.5% over the year. The median home value is more than $880,000. Perth led the monthly gains, followed by Brisbane, Adelaide, Darwin, Hobart, the regions, Canberra, Sydney and Melbourne.
We've seen a 10th consecutive month of growth in Australia's housing market, but the November numbers showed a bit of a slowdown in the pace of growth.
But Eliza Owen says that slowdown is not a surprise.
I think that much of the market momentum was being kept alive by rate cuts in 2025. So the fact that the outlook has changed, the November cash rate cut was off the table, and the mainstream view is that there might be one cut in 2026, is really changing buyer decision making.
Whether that turns people off, I don't know, because as I said, we've got such a shortage over here that I think it's just continually going to keep growing.
Another factor shaping the future of the housing market will be new lending limits.
From February, banks will only be able to lend 20% of new home loans to buyers borrowing more than 6 times their annual income. Experts say it's more of a preemptive move that won't do much to cool prices just yet.
Limiting high debt-to-income ratios at 20% of new originations seems pretty conservative when, at this stage, only around 5.5% of new originations are on those terms at the moment.
Looking into the new year, the pace of price growth is expected to slow further.
To be honest, I think the outlook for next year has seen this accumulation of headwinds. We've definitely shifted to a softer outlook for the market.
Denise, here we go. That's the brochure I've been telling you about. So finally we've got it.
In the nation's most expensive city, this buyer's agent thinks prices will keep rising.
Is there a ceiling in the property market? No, unfortunately there's not. Property is a function of supply and demand, and as long as the people have the money to buy property in Sydney, you'll always see Sydney leading the pack.
Rich Harvey says while talk of an interest rate hike has spooked some buyers, he's seeing many pull out all the stops to get on the property ladder.
There is a lot of old money circulating. The bank of mum and dad is always there behind the big five banks, and a lot of people are using equity or gifting now money to their kids to get into the property market early. On top of that, you've got the 5% home deposit scheme, and that's really putting petrol on the fire.
A hot housing market coming off the boil.
The business has uncovered kickbacks in the aged care system that are banned in other government-run programs. We've seen emails showing some providers of home care packages trying to coerce commissions from suppliers who help senior Australians stay in their homes. Chief Business Correspondent Ian Verinder reports.
This neat cottage in central Victoria has been Kevin and Sue Dawson's home for the past 15 years. It's where they're determined to stay, thanks to the federal government's home care package plan.
Staying at home is paramount from the point of view of being able to care for one another and try to live a normal life.
But a fight is brewing between the firms that supply vital equipment like wheelchairs and trolleys to couples like the Dawsons and the service providers that manage home care packages. The Peak Body for Equipment Suppliers says its members are being strong-armed to offer commissions to get the work.
My industry, the suppliers, the manufacturers, distributors of assistive technology, are being pressed by a number of service providers, people that hold the individuals' funds, to provide kickbacks, incentives, commissions. You know, it's borderline illegal.
Under the changes introduced last month, home care package providers have had their fee commissions slashed. Instead of keeping up to 30% of a recipient's funds, they can now charge a maximum of just 10%. Some are trying to recoup that lost money however they can. The ABC has obtained emails with direct requests for rebates and payments, in exchange for being put on an exclusive supplier list. The suppliers argue that such demands eat into their already slim profit margins and ultimately limit the choice for those most in need. Home care is big business. KPMG's Lauren Frost recently co-authored a report into aged care and the 855 home care providers running the scheme.
Government expenditure over the last few years has certainly increased into this sector, particularly in the support at home market, where we're seeing about $8.8 billion.
The providers manage recipients' funds and organise for services, including equipment, to be supplied to those in need, like the Dawsons.
There you go.
Signs of stress already are appearing. In recent weeks, 2 providers have hit the wall, one with thousands of employees and operations across 4 states. The biggest 25 providers soak up almost half of the government's expenditure, and they're getting bigger.
We are seeing larger providers growing. We are also seeing the market grow naturally just through that level of investment into the sector.
Tying up equipment suppliers to exclusive arrangements reduces the individual's right to choose as to where they buy their products. That's why this kind of grab for cash is explicitly banned from other government-run programs.
The NDIS states that you cannot offer commissions kickbacks. They're also very concerned about the conflict of interest. So it's really important that if someone has an arrangement with another provider, that conflict of interest is declared upfront to the individual and they can then decide.
None of the big service providers approached by the ABC responded, nor did the federal government. For the Dawsons, despite reservations about increased costs and the amount they have to contribute, they couldn't be happier with the equipment they've been provided.
We're very fortunate to have mobility chairs, and I've got help, trolleys in the kitchen to help carry food, a lot of things to make my day a lot easier.
A growing problem for an ageing population.
Just days after the Australian government launched its national AI plan, the US tech giant behind ChatGPT has announced it's expanding down under. OpenAI has opened a new office in Sydney and entered into a multi-billion-dollar deal with local tech company NextDC to build a massive data centre in New South Wales. In a bid to maintain its dominance, OpenAI will also partner with the Commonwealth Bank, offering AI training to their small business customers.
Over 40% of Australians use ChatGPT today. You also have 30,000 developers here building on top of these systems today for advanced AI applications for the future. So the demand is here, the enthusiasm is here, and we're excited to be here.
NextDC expects the new data centre to be fully operational by 2027. The market traded sideways this week as investors digested stronger economic data and weighed up the rate outlook. The ASX 200 closed up 0.2% stronger. The All Ords ended the trading week 0.1% higher. Julia Lee, head of client coverage at FTSE Russell, joined me. Julia, in Australia, we are talking about the prospect of interest rate hikes into next year, but at the moment, markets are waiting on a very politicised potential US rate cut next week. How's that playing out on markets?
Well, first of all, rate cuts are great news for businesses because usually it stimulates demand. So for the share market, which is a market full of businesses, it's usually good news. So the US, where an interest rate cut is expected, we're seeing the US stock market close to all-time record highs. Traders have priced in about a 90% chance that we're going to see that rate cut next week, but it's very different to the rest of the world. If we have a look at Japan, there's lots of action going on there as well, but they're expecting to see a rate hike in December. So we've seen the Japanese stock markets with some weakness on Friday, but we've also seen Japanese bond yields soaring to the highest that we've seen in about 18 years.
Data centre provider NextDC has just cut the ribbon on a new facility in Sydney in conjunction with OpenAI. I mean, demand for artificial intelligence is really playing out on our market today.
Well, we know that technology and AI has been a key driver of share market returns this year, and it's NextDC's turn. We've seen the share price popping on the news of this memorandum of understanding with ChatGPT's owner, OpenAI. So this facility, the S7 site in Sydney at Eastern Creek, it's going to be absolutely huge. It's going to have an AI facility, a campus, as well as a supercluster for graphic processing units. The news, of course, has been great news, but it's also part of OpenAI's Australia program, and it's an economic blueprint to try and get widespread AI adoption as well as encourage infrastructure investment. But great news for the technology sector today in Australia.
I mean, conversely, there's signs of weakness in retail with Premier Investments' latest news knocking its shares.
Yeah, we have seen Premier Investment shares coming under pressure. The shares down around about 7% today, and we did see in the year to date, the shares are down a huge 35%. So what we are seeing at Premier Investments is that it looks like the first half has fallen short of expectations. They've said that underlying earnings is likely to come in at $120 million, but the market was expecting $140 million, and that's why the shares fell. There's a lot that's happened at Premier Investment this year. Earlier on in the year, we saw them offloading their apparels brand business to Myer. So now the business only has two brands, and that's Smiggles as well as Peter Alexander. It's the Smiggles part of the business that's really dragged down the expectations. In fact, Peter Alexander's seen a record revenue period during the Black Friday and Cyber Monday promotional period.
Now, when it comes to currency markets, the US dollar is close to a 5-week low. What does that mean for investors?
Yeah, I think the US dollar being weak has been a theme that we've seen all throughout 2025. So if we have a look at the US currency versus a basket of currencies, down around about 9%. Now that's the weakest trading that we've seen for the US currency in a number of years. So if we have a look at the impact that has on investors, first of all, we're a very big commodity-based economy. So a weaker US currency usually means stronger commodity prices. And we've certainly seen that throughout this year. Secondly, for Australian investors, it means that when we're invested overseas, usually it takes away from our investment because you want to see the currency that you're invested in rise while you're invested. But conversely, thirdly, for foreign investors investing into Australia, it's been great news because the Australian dollar has strengthened, which means the currency component of their investment has gone up. So lots of impacts in terms of the currency. I think the good news for Australian investors is that it's really helped commodity prices this year.
We talked about rate cuts earlier in the US. Do you think that could potentially fan a Santa Claus rally?
I think all eyes on rates to help fan a potential Santa Claus rally. Now, we call it the Santa Claus rally, that period between Christmas and New Year's. There's only a very few days of trading, but combined with not a lot of volume going through, it usually means that we do see a positive impact for investors. So watching US rates closely because that's really going to set the scene. They say when the US sneezes, the rest of the world catches a cold. I think that will certainly be the case in terms of rates.
Julia Lee, thank you so much.
Thanks, Alicia.
Small businesses have long battled against shoplifting. Now they're also facing a rising trend in online theft. Known as chargebacks, it involves customers making fraudulent claims for refunds. Adelaide Miller reports.
You wouldn't believe it, it's happened again. This customer has just done a chargeback saying I'm fraudulent.
This fashion store owner took to her social media after losing $1,000 worth of stock from online orders.
The customer, they had confirmed they'd placed the orders, they were legitimate, and then I even have photos from Australia Post that the parcels were delivered. I'm honestly shocked. Is the system broken? Do I need to...
After the payment was withdrawn, Sam Kemp posted her experience online, and it went viral.
I've had hundreds and hundreds of messages from other small businesses, messaging's the same thing happening to them. The losses are huge for small businesses and the stresses are enormous.
Ainsley is another small business owner who's fallen victim to fraudulent chargebacks.
You start doubting yourself about when you're posting things out. Is it going to be safe? Is it not?
The fashion store owner said she even spoke to one customer on the phone about sizing before that customer ordered the item online.
Then maybe 5 or 6 weeks later I got the drawback thing and I tried to call her and she just hung up and then that was it. I didn't hear another thing from her.
Fraudulent chargebacks work like this. The customer orders a product online. Once it arrives, they contact their bank, claiming they never made the purchase. The money is then taken back from the business and put into the customer's account.
There's bad actors who know that there is a zero liability
feature for Visa and MasterCard where if you genuinely didn't make the transaction, then you're not liable for it. Merchant fees are decreasing because fintechs are great. But if
Brad Kelly's firm represents about 120,000 small businesses and their payment systems. He says because of the volume of chargeback requests, often the easier option is to dismiss the dispute.
those chargebacks are becoming more expensive for those acquirers to process. Therefore, at a certain point, they're looking at the merchant and just sort of waving it through and there's nothing to see here.
The Australian Banking Association told the ABC it's aware of fraudulent chargeback concerns with small businesses, and where possible, banks will work with them to resolve the disputes. But it has to be within the card network providers' timeframes and rules. MasterCard didn't comment, but Visa said it had introduced rules allowing businesses to use historical purchasing data to fight friendly fraud. This is designed to protect businesses from repeat chargeback abuse. But Brad Kelly says businesses can end up as the ultimate losers.
So the more chargebacks they get, the more red flags are on their account. Now, they can be exited if they have too many red flags. And if they're exited, it makes it very difficult for them to get another facility. So this becomes a really difficult situation very quickly for merchants who are acting in good faith.
Sam Kemp is taking her case to Parliament. She met with Victoria's Shadow Minister for Small Business to call for better protection for businesses like hers.
With increases in super, wages, costs of everything in small business, we just can't keep having these chargebacks come from the banks.
The banks do have responsibility, and what I'll be doing on behalf of Sam and on behalf of small businesses right across this state and perhaps more broadly the country is writing to the CEOs of the 4 big banks to say to them, pull your finger out and look after these people.
Because the customer isn't always right.
And that's all from Close of Business. I'm Alicia Barry. Thanks for watching.